Hello everyone. Welcome to today's webinar titled What Tax Reform Means for Your Business. My name is Rihanna Collier and I am Vice President and Managing Director of SIA's Software and Services Division and also the Tech Council of Southern California. And we are joined today by our good friends from Grant Thornton who will be taking you through today's timely discussion. We have with us Randy Free, Partner of International Tax Services, and Dustin Stamper, Director of Tax. Before I turn it over to these gentlemen, just a little bit about who SIA is, who the Software and Services Division and the Tech Council. The Software and Services Division of SIA focuses on the ISV community, so not specific to any size or vertical. And then the Tech Council of Southern California is a regional chapter of the Software and Services Division, focusing specifically on technology innovation happening in Southern California. SIA is our global organization representing the global interests of the software and digital content industries. So within SIA we have multiple divisions. I mentioned the Software and Services Division and the Technology Council. But we also have other divisions to make sure that we serve all of our constituents across all the divisions. And through all the divisions we strive to do, we all strive for the same mission. So it's to advocate on behalf of our members, provide professional and business development opportunities, create peer networking and thought leadership opportunities, and of course provide pertinent industry education to our members. So how do you get involved? This slide is specific to the software and services side of the organization. However, many of these opportunities also apply to the other divisions from the previous slide. So our members take advantage of our communities, our events, our marketing and PR support, market research, and of course opportunities to showcase their thought leadership through things like speaking opportunities and board participations. We have a robust calendar of events. It's constantly evolving, so more programming will be added for this year, but this just gives you kind of a glimpse onto some of the opportunities that are up and coming within SIA and the Software and Services Division and the Tech Council of Southern California. In particular, I just want to highlight one event, and that is the SIA Annual Conference and Cody Awards, which is taking place June 11th through the 13th in San Francisco. This particular conference brings together really the best of SIA and the best of our industry to discuss growth strategies. You can go, I don't have the URL up there, but you can go to sia.net/annual for more information. Finally, let me go back one. Finally, we'd be delighted, of course, to have your participation in the various SIA activities. We have individual and corporate memberships available. My contact details are there on the screen, so you can feel free to contact me with any questions. There's certainly a lot of opportunities for many of you to be actively involved, and we would love to have your participation. So before I turn it over to our presenters for why we're here today, just a couple of housekeeping reminders. This webinar will be recorded, and the recording along with the slide deck will be sent out to you later today. All of your phone lines are on mute. However, we want to be sure to address any questions that you have. You can ask your questions throughout the presentation in the chat box on the left of your screen. As you can imagine, this topic is very timely for our businesses today. So I hope you will take this opportunity to leverage the experts that we have with us today and ask any relevant questions, again, using that chat box on the bottom left of your screen. Also, during the course of today's presentation, we will have some polling questions for the audience. You will see the question and answer choices on your screen. Our presenters will then give you a moment to select your answer. They will then move to the next screen where you will then be asked to put in your answer, A, B, C, D, etc. So please note your answers when they instruct you to. Now without further ado, on to why we're here today to talk about how the new tax reform affects our technology businesses. I would like to now turn it over to Randy Free, Partner of International Tax Services with Grant Thornton, who will kick us off. Randy?
Hi, thank you, Rihanna. Can you hear me?
Yes, I can hear you.
All right, perfect. I'm going to take us through a very quick overview of the international tax section of tax reform. And looks like I need to advance our slides forward here just a bit. So let me go to the international section of our slide deck.
Randy, would it make sense for me to kind of go first and then hand it over to you to do international?
Certainly, that would work very well.
Okay. Let me go back here. Thanks, Randy. It might be a little easier for us to start with just a brief overview of sort of the context of how the bill was enacted, and not to revisit the process, but I think it's important to keep a couple things in mind, both for how some of these changes are going to be implemented, and for the long-term planning considerations. And I want to echo what you just heard, that we are more than happy to take any questions. I'm going to try and keep my eye on the Q&A and the questions and answer any that I see come in. I will warn you that it is possible to stump me. For one, this is a 500-page bill. I'm not an expert in every federal provision, although I've got a pretty good grasp of most of them. And also because some of the areas are still incomplete or uncertain. They enacted this bill very quickly, and there are certainly some ambiguous areas, which is kind of what I want to talk about in the overview. First, I think there's a couple important takeaways. One, this is basically a $1.5 trillion tax cut. The slide there says billion, but we meant trillion. A $1.5 trillion tax cut over the next 10 years. And so there's been a lot of talk about who's getting a tax cut and who's not. Certainly almost every business is going to do better under this than before. Even individuals, there are certain specific individuals that, depending on their individual characteristics, could do a little bit worse under this tax bill. But the vast majority, even in high tax states, are going to get a tax cut out of this. The Treasury's best estimates are that 80% of taxpayers are going to get a tax cut. This is individuals. 15% of taxpayers will do about the same, and only 5% of taxpayers could see an increase. I think the other important thing to keep in mind is that this bill was passed under the reconciliation process. And this was because they did not have 60 votes in the Senate to do what they wanted to, the Republicans, and so they had to use a special process. And one of the limitations of this special process is that you cannot lose revenue outside the budget window. So how do you pass a tax cut that costs $1.5 trillion over the next 10 years and make sure it doesn't lose revenue after that? What they did was they expire every single individual provision in the tax code, basically every single individual provision in the tax code. So the lower rates that individuals get, all scheduled to go away. On the plus side, some of the limitations on your itemized deductions will go away as well. The pass-through deduction, which is important to businesses organized as pass-throughs, is scheduled to go away as well. There are a couple provisions, individual provisions, that are permanent. One is slower inflation adjustments, which is sort of a backdoor hidden tax increase that we probably won't feel for quite a while, but that will make a difference 10, 11, 12 years down the road. The other piece is the repeal of the individual mandate is also a permanent change. That is scored as a revenue raiser, even though all you are doing is repealing a tax, but we won't get into that for purposes of this webcast. The reconciliation process brings up a big question, and if half of this bill is scheduled to expire in 10 years, is this bill really meant to last? And I think it's important to keep in mind when you ask that question that this legislation was passed super quickly for a bill this large. They did talk about tax reform for much of the year, but when it came to actually writing the legislation, they wrote it and rewrote it about 3 times in the course of a month. And they were writing it on the fly, and this is an actual screenshot of the bill, the Senate version of the bill that they voted on. It literally had writing in the margins. You may have seen this before because Democrats used it as a talking point, and despite the fact that it makes good political theater, it's also true. This was a bill written on the fly with writing in the margins, and that means that it is filled, unfortunately, with a lot of technical glitches, a lot of ambiguous sections, and some results that are totally unintended. So the big question is going forward for folks who are grappling with this and have to prepare tax reforms and have to do tax planning is, okay, can they fix some of these areas? And Democrats are taking a little bit of a page out of the Republican playbook and saying, what Republicans did with ACA is, there's a lot of things Democrats wanted to fix, and they said, we hate this bill. We're not going to help you fix this bill. We want to repeal this bill. And they basically stonewalled them on it. So Democrats are taking a little bit of that tack and have said, okay, no Democrat should introduce individual standalone bills amending tax reform because we want to have a unified platform that is basically sort of, repeal and replace to run on for 2018. That said, Democrats are being a little more fluid. There were 3 minor corrections already made on the last spending bill that was passed, and so we could see the ability for Republicans and Democrats to come together on a few fixes, kind of nibbling around the edges, but I do not think we are going to see a big technical corrections package that's going to fix all of this stuff. IRS guidance can certainly address some of this. The IRS has already released their priority guidance plan that goes through their 18 top projects they want to get to this year, but that's hardly going to get rid of all the issues. So that brings us back to this question of how permanent really is this? And I think one of the questions is, one of the things you want to look at is, okay, partisan reconciliation bills in the past haven't been a great process, haven't turned out to be that great of a way to make permanent law. If you look at the 2001 and 2003 tax cuts that were passed in a similar way, by 2012, much of those had been reversed, at least to the high income levels, and you ended up with a permanent version of those that really was more of a Democratic than a Republican legislative endeavor. You're seeing the same thing happen with ACA. When you do something in a partisan matter along reconciliation lines, the other party can usually make a lot of political gains campaigning on, oh, they missed this or they missed that, and elect us into office, and we'll reverse that. And it worked a lot for the GOP. And although repeal and replace on the healthcare side turned out a lot harder than they thought last year, they did in the end repeal a huge part of it with the individual mandate, which some economists think will sort of unravel all of ACA in a couple years. So I think we're going to see the same process play out over the next year, and that Democrats are going to have this platform of, oh, this isn't good for individuals. It's mostly about, tax cut for corporations and rich folks, and they're going to campaign on a platform of trying to erase some of this. And even if they can't do that in the near term, certainly the expiration of half of this bill in 8 years is going to give them a lot of leverage going forward. And that makes planning somewhat difficult on a long-term basis. But with that sort of bad news out of the way, I think everyone's probably anxious to get into exactly what some of the provisions do and what they mean for tech companies.
And Dustin, it certainly made it difficult for our public filers to get their financial statements in order and to report the impact of this tax reform bill. With the lack of clarity, it's created a real struggle for a lot of clients.
Yes, that's a great point, Randy. There are some immediate issues that folks are dealing with, and some opportunities, and financial reporting aspects have been one of the hardest. So, the big centerpiece of this legislation is a corporate rate cut. It went from 35% to 21%. That's a huge rate cut. We had one of the highest corporate rates in the world. Now we're, better than average when compared to the rest of the OECD. Individuals did not get quite as deep of a rate cut. They went from 39.6 at the top rate to 37%. There was a recognition that a lot of business activity does flow through the individual tax rates because of pass-through businesses like S-corps and partnerships. And so they realized this huge rate cut for corporations as opposed to individuals would create maybe an imbalance there. So what they did was provide this 20% deduction against certain pass-through income, and I'll get into the details on some of that in a minute. But that essentially creates an effective rate on pass-through income that qualifies fully for the deduction of 29.6%. But that's still a pretty big gap between 21% and basically 30%. And I'll also talk a little bit about sort of entity choice and how it changes how you might want to organize, whether you're a pass-through or a C-corp. I think one of the big things I'd like to point out here for the technology sector, and really for most taxpayers in general, is that a cut in the rate from one year to the next provides a huge rate arbitrage opportunity. There are dozens of accounting method changes you can make for how you recognize income and expenses that you can make automatically when you file your return. So if you haven't filed your return yet, You can look at your fixed assets to pull capitalized assets out and depreciate them sooner. You can make an accounting method change that will give you an immediate deduction for 2017. So there are still things you can do to shift income that would be recognized this year or in a later year, or that would be recognized in 2017, so it's recognized in 2018 or a later year, or shift a deduction that you wouldn't get until this year or next year into 2017 against the higher rate. We've already helped a lot of folks do this. If you haven't thought about this, you really should. It's easy money. You might have seen in the press there's been some big news stories about big companies actually paying into their pensions early because you can do that and deduct it all the way up until you file your return. So it is something that a lot of companies are thinking about and doing. Which brings us to our first polling question. Has your organization taken advantage of planning to benefit from the corporate rate reduction? Now remember, these polling questions are a little weird. You have to read this now and sort of mentally pick your answer, because on the next question is when you're going on the next slide is when you're going to be able to put in the answer, but we will no longer have the answers written out there. So the choices are we've performed a comprehensive review of our tax positions and we're planning to accelerate or defer, considering planning but haven't reviewed, we haven't done anything, or we're projected to have an NOL this year and will not benefit from planning. And that one's a little bit of a trick. Okay, here's where you can go ahead and put in what your answer is. Because even if you have an NOL this year, there's some special rules around NOLs that are going to be limited to how much you can use them in the future to only 80% of taxable income, unless that NOL arises in 2017 or earlier. Then you sort of get out of that limitation. So even if you're in a loss position for 2017, you still want to think about grossing up deductions and pushing out income, because you want your NOLs to be 2017 NOLs instead of 2018 NOLs, because it makes them easier to use in the future. Okay, it looks like a fair number of people have done some planning, which is good. I hope to see that. Although it is split pretty evenly, and there are some folks who haven't done anything at all. It is not too late to think about that. Okay, I promised I would get to the pass-through deduction. So what this is instead of providing a reduced rate on pass-throughs, they provide you this deduction that is supposed to lower your effective rate. In general, it applies to most types of ordinary business income, plus it applies to rental income. Investment income like dividends and capital gains and interest is generally not going to qualify for the deduction. In addition, there's two limitations to the 20% deduction that are important here. One of it is that they wanted to make sure it's really not a service type of business, and it's just not you working on behalf of your pass-through, and there's actually employees, you're employing folks, or there's equipment that you've invested in this. So your deduction is limited to either 50% of the actual wages that your business pays, or 25% of the wages that your business pays, and 2.5% of the original cost of any depreciable asset. So if you bought a bunch of equipment or if you bought a building, you get to take 2.5% of the cost of that and add it to 25% of your wage expense as a business and reach that calculation. So in general, if you're paying half of your net income as wages, you'll be fine on this. In addition, it excludes most types of service businesses. There's a long list of these. This is most consulting. It's possible that there are technology companies that could be caught up and excluded under this. There's a catch-all in there that says, number one, consulting, but also if your business depends on the reputation or skill or of one or more of employees or owners, meaning you're basically consulting, it's your name on the shingle. People are hiring you and not necessarily the business, or the business is essentially you. You could lose your deduction. Now there is an exception for both of these limitations according to wages and the service businesses, that if you're under $315,000, if you're a joint filer, you get to take your deduction in full. It's half that if you're an individual single taxpayer. I think the big takeaway here is when you look at this, even if this deduction, first of all, is limited in some pretty strict ways. Number two, even if you get it in full, it only brings down your rate to 30%, whereas if you're a corporation, you're at a 21% rate. So that really has brought up this question of, wow, does it still make sense to be a pass-through? Should I think about converting to a C corporation? Would I pay less tax? And that's actually a pretty complex question. It seems easy on its face, but it really depends on how you plan to distribute your earnings, because C corporations still pay a second layer of tax to the extent they distribute dividends. So this is a simple table, just a basic table showing, okay, if you leave everything in the C corporation, then you're generally going to pay a lower rate. If you distribute everything out, you're much better as a pass-through. If you distribute half, it kind of shows you where that middle ground is. But this is only really a part of the consideration, because even if you retain most of your earnings on an ongoing basis, eventually at some point you're going to probably want those earnings out of the business, whether to pass on to heirs or sell it. Exit plans for tech companies can be hugely important, so that's something to consider. There's a lot of other important considerations, like what kind of accounting methods that you can use as a pass-through C corporation, whether there's any cost to conversion itself. Certainly the state taxes, you actually get a better answer as a C corporation than a pass-through, because individuals are limited in the amount of state taxes they can deduct. So this is something that you can figure out. You can crunch the numbers and do the math, but it is something you will have to spend a little time or a little money to really figure out. Okay, another big push here as part of the legislation was to encourage investment in business. And one of the ways they did that was to double bonus depreciation, which now basically for the next 5 years allows you to fully expense qualified property that you place in service through 2022. And qualified property is basically anything with a depreciable that you can depreciate over 20 years or less. And that basically means almost anything but like a building. There's another big expansion to this that I think that is important to point out, and that is used property now qualifies for this 100% bonus depreciation for the first time. That was never the case in the past with 50% bonus depreciation. This is proving to be very big in the M&A space, because now like an asset purchase isn't just you get the depreciation write-offs, you actually get to fully expense all the equipment and anything that's a hard depreciable asset that's part of that asset acquisition. For the technology industry in the M&A space, probably a lot of what you're buying might be intangible, so it might not be quite as big of a deal. On the other hand, remember, software does qualify for bonus depreciation, so that is certainly a big consideration in the tech space. Provisions, which I think are very important for the tech sector before I hand it off to Randy. I think the biggest great thing here is that the R&D credit survived intact fully, still 20%. There was talk of dialing that back or making it more narrow, and so tech companies both get the research credit in full and the rate cut. That's great. There are some things that did cut the other way. The Section 189 deduction for producing or manufacturing things in the U.S. in which software generally qualified has been repealed. That was always sort of understood as it was going to be a trade-off for the rate cut. Some other more narrow provisions that we were expecting maybe were, if you're an individual, so if you are, working through a pass-through, there is some provisions that allow you currently to get capital gains treatment for self-created intellectual property. There are some new limitations on that. In the interest of time, I won't dive into details about that, but that is something to kind of look at, I think. And then the other big one here is that Section 174 expensing for R&D is going away, but not for 5 years. And this is one of these sunrise provisions meant to make this be revenue neutral outside the 10-year budget window. And so this is a real pain for a couple reasons. Number one, people might not normally break out their research costs from other costs that they can expense. So now not only are you getting a worse tax answer, but you do have to do a lot of work to segregate these costs to figure out the new bad tax answer. The one silver lining here might be for the software industry, and maybe this is too much of a stretch, but software purchases will be able to be recovered over 5 years, whereas in-house research for software development will be 5-year cost recovery. So it could spur some more interest in buying software off the shelf. But again, we're not even sure whether this one is going to take effect. It could be one that Congress easily looks to postpone when it comes along to take effect. Okay, I promised to get to the interest deduction. Essentially, this is meant as a trade-off for full expensing, and that if you buy something with debt, it's sort of unfair, and economists would say you have a negative tax rate if you get to fully expense it and then also get to deduct the debt. But the way they went about it was sort of weird. Is instead of just trying to tie to most depreciation, they just have a set haircut where if your interest expense in excess of any interest in income you have, so your net interest expense, exceeds 30% of this measure of sort of adjusted taxable income that's close to EBITDA, which means you get to take out like interest and depreciation and amortization out. So that helps you by bumping up your taxable income a little bit. If that deduction is in excess of 30% of that, it is cut off. And so again, this hasn't proved super painful yet to a broad area of the economy, but certainly the private equity model is worried about it. In a couple years, if we have another downturn and everyone's taxable income crashes through the floor, at some point, suddenly everyone's going to lose their interest deduction, especially if interest rates creep up over the next few years. The calculation is also supposed to get a little bit worse starting in 2022 and going forward. Couple other things. AMT and NOL I think are big for the tech space, at least for the startups in the tech space, because often you can have losses generated in the early years that you're using against taxable income in the future once plans come to fruition. The good news here is the corporate AMT is repealed. So if you have existing AMT, maybe because of loss limitations in early years, you're allowed to monetize this if you're a corporation over the next 4 years. If you have AMTs and you're a pass-through, you have individual AMTs, sorry, AMT exemption levels were bumped up, but you do not get the same treatment. Only problem is if you monetize these and get a refundable payment, if you don't have any actual taxable income to offset, the sequestration, which is this crazy budget thing, essentially takes 7% off the top of any refundable payment amount. The problem here is that the AMT repeal is somewhat hollow for startups because a lot of times what would push you into the AMT is the AMT had this 90% limit on using net operating losses. So if you had a bunch of net operating losses that would have otherwise offset all of your income, you could only offset 90% of it, and the rest would kind of be an AMT credit going forward. So even though the AMT is gone, one of the big things to push you into the AMT, that net operating loss offset, has gotten worse outside of the AMT. They implemented this new provision in which net operating losses can only offset 80% of taxable income going forward. So if you have a couple $100 of NOLs and 1 year you finally start making some money, you have $100 worth of income. Despite having $200 worth of NOLs, you can only use $80 of those NOLs in that year, and you have to pay tax on the remaining income. There's an interesting little grandfathering provision that if your NOLs are from before 2018, they're not subject to either the old AMT limit or the new limit, so they're going to get a great answer. That's why I said early on, even if you're in a loss position, bump up those deductions this year if you can. Contributions to capital, another big item in the tech space. The tech sector brings a lot of jobs that are exactly the type communities want: high level, high paying, good jobs. A lot of communities will offer benefits and add backs and tax breaks for tech companies to locate in their areas. Under this change in the bill, essentially if it's coming from a customer or a potential future customer, or if it's from a state and local government, it's considered a contribution to capital, which is going to be most of these incentives generally. Then it's going to have to be included in income from now on. And finally, before I hand it off to Randy, because really some of the international changes are the biggest here, there is a big piece for any public companies we have on the phone. There's currently this limit that you can only deduct executive compensation up to $1 million, but there's this huge loophole that people have been driving all kinds of compensation through for years, and that it didn't apply to incentive compensation. They have now gotten rid of that loophole. So anything over $1 million, regardless of its incentives, stock options, doesn't matter. You can no longer deduct it as a public company. In addition, they've expanded it so that if you were ever one of these covered employees, meaning you're one of the top paid or you're specifically CEO or CFO, you always are. So even if you roll off one of those roles but are still receiving compensation from the company no longer gets a deduction for that. So you could see 7, 8, 9 years down the road, as people roll off of certain roles or no longer higher paid, they will continue to be on this list, and you could have 9, 10, 11 people that you cannot deduct their pay. One of the big questions here is there's a grandfathering provision if you had a contract for a compensation program in place before enactment of this legislation. And so a lot of the big questions are, what exactly does that mean? Our compensation and benefits folks are still sort of struggling with this issue, and the IRS guidance is going to make a big difference there. Before I hand it over to Randy, I will answer the one question I did get that I saw, and it was about the pass-through deduction and consulting services. And the question is, okay, if a company has a mix of consulting services and also stuff that they sell, you sell a software product off the shelf, do you qualify for the deduction? And this is one of those areas, that's a great question. This is one of those areas that's a little ambiguous and that we're still trying to figure out. On its face, the deduction is tied to a trade or business and not an entity, so presumably you could have different trades or businesses in an entity. At the same time, there's other parts of the legislative text that really allocate certain parts, allocate certain tests and certain aspects of the test by entity. So I think it's a lot going to depend on how the IRS comes out on that. We and others will certainly be pushing to allow folks to set trade or businesses reasonably either within, having multiple within one entity, or even having a trade or businesses that crosses a few entities. And with that, Randy, I'll pass it over to you. I apologize for squeezing your time because of the technological challenges here.
No worries, Dustin. Thank you. Thanks for covering all that's going on the federal tax side. We are going to fly through some international topics, so I hope you have your seatbelts on. We have 7 topics to cover. We're going to talk about the quasi-territorial system and the dividends received deduction, the transition tax, the GILTI tax, the FDII incentive, the base erosion anti-abuse tax, as well as some anti-hybrid provisions and some modifications to the existing Subpart F rules. I'm really excited about tax reform because I love math, and there's actually quite a bit of math in these provisions, and the provisions are not intuitive, and it takes a fair amount of modeling to really understand what's going on here. So we're going to jump into the dividends received deduction. New Section 245A established a participation exemption, and this is essentially a 100% dividends received deduction for foreign source dividends. And this all sounds great until you realize that the dividends received deduction, the amount available for that deduction, comes at the end of the calculation. So you start off with your current year earnings and profits. You back out your Subpart F income, so any inclusion in the current year under Subpart F as it existed prior to tax reform. You next reduce your earnings, the foreign earnings, for the new GILTI inclusion, and we'll talk about what that means a little bit later. And any remainder is available for the dividends received deduction. And you might say, what remainder? And you'd be right to ask that, because the way the GILTI provision works, technology companies in particular may find that their offshore earnings are being fully brought into the U.S. either under Subpart F and or GILTI, and very little earnings are left over to benefit under the dividends received deduction. So we'll talk through the GILTI tax as we go forward, but just know that dividends received deduction is there. The insights box at the bottom of the slide is important to remember that it's not required that the foreign corporation be a CFC in order for the U.S. shareholder to qualify for the dividends received deduction, so that's a nice benefit. However, the DRD is only available for corporations, meaning individuals that own foreign subsidiaries directly do not qualify, unfortunately. So let's talk about the transitional tax. Sort of the main focus has been over the last few weeks for public filers is to get a good estimate of the transition tax for their financial statements. Section 965 was amended so that there is now a tax on the deferred foreign earnings of specified foreign corporations. And this foreign earnings is taxed under 2 categories, if you will. There's a tax on cash and cash equivalents at 15.5%, and there's a tax on non-cash assets of 8%. Now, the includable amount, the amount of foreign deferred earnings that's included in this calculation, is earnings that were accumulated post-1986 by specified foreign corporations, excluding any ECI or previously taxed income that was earned by the foreign entity. You might ask, what is a specified foreign corporation? Specified foreign corporation includes any controlled foreign corporation. It also includes any foreign corporation that has at least one U.S. domestic corporation as a shareholder, as a U.S. shareholder. And you should note in determining the specified foreign corporation status that the attribution rules under 958b4 have changed so that you now have downward attribution from a foreign parent to a U.S. subsidiary of that foreign parent. So as these rules are applied, when you have that situation, a U.S. subsidiary, a foreign parent, the U.S. subsidiary now is considered to own the shares owned by the foreign parent of foreign affiliates. So you have to take that into consideration. This transitional tax directly and maybe even disproportionately is attracted to technology companies. As you can imagine, many technology companies have a large amount of cash offshore, and as I pointed out, cash is the cash portion of the earnings and profits of these foreign corporations are taxed at the higher rate of 15.5%. There's two measurement dates when you're measuring the deferred foreign earnings, November 2nd or December 31st, and you're meant to take the higher two of those two balances. One good thing is that you are allowed to consider deficits. So if you have deficits in a foreign subsidiary and you have at least one foreign subsidiary with deferred foreign income, you are allowed to allocate that deficit into the entity with the positive EMP. And so that allows you to reduce the amount of inclusion under the one-time tax or the transitional tax regime. The deficits are determined at the aggregate and then allocated out across the group pro rata. The measurement date for deficits is November 2nd. So you should take note of that whenever you're calculating both your foreign deferred earnings and those that have deficits. When you have a deficit company that is, the deficit is then allocated to other entities with foreign earnings, the foreign tax credit of that deficit company is lost, and you will end up picking up a reduced amount of foreign tax credit out of the entity that's receiving the benefit of the deficit, because you're taking your pro rata share, if you will, out of the tax pool. The inclusion is reduced, and therefore the pro rata share is smaller. So as I mentioned, under the transition tax, the deferred earnings are taxed under two different rates, one for cash and one for non-cash. So that means that the determination of your cash position is now important. So cash is measured as the greater of two measurement dates. One is the close of the last tax year beginning before 2018, or it's the average of the preceding 2 years, or the 2 years prior to the date of the close. So you'd need to look at the trial balances of each of your specified foreign corporations, identify the cash positions on the measurement dates, look at the year-end and the 2-year average to determine which is greater, and then that amount becomes your cash position. Cash itself is defined as cash as well as accounts receivable, which you're allowed to net accounts receivable payable, and it includes the fair market value of several items, including short-term receivables, which mature in less than 1 year. If you have a fiscal year and not a calendar year, there may be some opportunity now before the close of your fiscal year to reduce the cash balance so that the cash balance at the end of your fiscal year is at least and not greater than the 2-year average. So if you're taking a look and you've got a fiscal year and your year-end cash balance looks like it's going to be higher than the 2-year average, you could take steps to pay that down, which would help reduce the cash portion of the transition tax and put more of the EMP into the non-cash or the 8% basket. So let's look at a quick example of the one-time or transitional tax. So you will start with calculating the 965 inclusion, and in this case we're going to assume that that is $10 million, and it just so happens in this example that we're allocating it pro rata 50-50 between cash and non-cash. So the step there would have been, okay, we calculated the inclusion, $10 million, then we calculate our cash position. Our cash position in this example is $5 million, so any remainder is allocated to non-cash. So in this case, it's $5 million in each of the buckets. You then calculate what is referred to as the participation exemption. The way the tax works, the inclusion is taxed at the federal standard rate. To get to the 15.5% and the 8% rate in each basket, they're going to allow a participation exemption deduction that gets you to an effective rate of 15.5 and 8. So this third step is to calculate the participation exemption, which is the deduction, and then come down to calculate and allocate the foreign tax credit that's related to that deduction. This one does not have foreign taxes included in the example. So we're just looking at the inclusion less the participation exemption. That comes down to our inclusion that's subject to tax affecting that at the 35% rate to come down to the U.S. pre-credit tax liability, and you can see that the effective rate is 15.5 and 8% respectively. So we've talked about the dividends received deduction and the transition tax. Now let's go to the GILTI tax that I mentioned earlier. The GILTI tax stands for Global Intangible Low Taxed Income. And this is a new section under 951A that imposes a current U.S. tax on returns that exceed a routine return. So the regulations now allow a routine return, which is calculated as 10% of the foreign entity's aggregate adjusted basis in its qualified business asset investment, or QBI. So for each of your foreign affiliates, you'll need to determine what is the qualified business asset investment, the QBI, and look at 10% of that, and that becomes your routine return. Returns greater than that amount will be included in income under the GILTI regime. So the calculation is done at an entity-by-entity basis. There is a 50% deduction allowed against the inclusion unless the U.S. entity, the parent, is in a loss, and then the deduction is ratcheted down for the loss. Individuals, it should be noted, again, here there's a difference for individual owners of foreign corporations. There is no 50% deduction. So individuals are taxed on 100% of their includable income under this GILTI tax. Some other insights is, again, this GILTI tax specifically targets the typical tech company structure. If you think about technology companies that have established operations in Ireland or Switzerland, in the Netherlands with tax rulings so that they have a very low tax income, when you look at the GILTI calculation, those technology companies typically are going to have a very low qualified business asset investment, meaning that they do not have a lot of depreciable assets deployed in those foreign countries. And therefore, their routine return is going to be quite low. And that will cause a majority of their income potentially to be brought into income under this GILTI regime. Theoretically, because of the way the mathematics works, this would only apply to operations that are subject to a tax rate of less than 13.125%. So again, looking at low taxed income. If the foreign operations have an effective rate of 13.125 or greater, The idea is that your foreign tax credit that's allowed would offset any additional U.S. tax, and therefore there wouldn't be an additional inclusion. Now, there's a lot of debate rather this type of sort of penalty, if you will. This is what we refer to as the stick, and I'll talk about the carrot a little bit later. If this stick will cause multinationals to onshore high-value operations or move them out of cash box jurisdictions in order to avoid this GILTI tax. It should also be noted that for foreign affiliates that have deficits, their qualified business asset investment does not get included and therefore does not increase the routine return. So that's a detriment. And there's a planning opportunity there to sort of drop and check perhaps entities with deficits under entities, foreign entities with profits, so that their qualified business asset investment can be included and increase the routine return. So why do we talk about GILTI as sort of being a minimum tax? I mentioned that I'm sorry, we've got a polling question. Let's go to the polling question and then we'll talk about the minimum tax. So our first polling question in the international section, how does your organization plan to use cash brought back to the U.S. resulting from the mandatory deemed repatriation? Would you use it to increase production in the U.S. or employment, for acquisitions, to pay dividends or stock buybacks, to pay off debt, or perhaps you're just uncertain and don't expect to bring back cash in the near term? So take a look at those, pick your choice, and then we'll go to the selection slide. And this question gets to the heart of the matter of the transitional tax. Now that that income has been subject to the transitional tax, it's considered to be previously taxed and can be brought back potentially to the U.S. without further federal income tax. There may be state tax consequences, and there may also be local withholding tax consequences. So it looks like a number of you have now replied. We're going to skip ahead, see if we can. So it looks like some of you have started to consider some uses of those cash, and then others are uncertain or have decided not to repatriate cash. So very interesting, sort of a split between the intended results there. As I mentioned, the minimum tax under GILTI can be considered a global minimum tax, because if you look at the left-hand side of this chart, if your effective tax rate, as I mentioned, is 13.125% or higher, your U.S. effective tax rate on this inclusion should be about 0, depending on your ability to use foreign tax credits. As you slide across to the right-hand side of the screen and your effective foreign tax rate goes down, you can see then that there's a corresponding increase in the U.S. effective tax rate up to 10.5%, which is 50% of the 21% new federal rate. Remember, there's a 50% deduction on the GILTI inclusion for corporate entities. I have a couple of examples in here. I'm going to skip past this one because it's also included in the next example. So I'll go into that in a little bit more detail when we get to that next slide for the sake of time. This is the carrot. So I mentioned the stick is the GILTI income. So you're GILTI and you have inclusion if you're earning foreign source income offshore related to intangibles. The carrot gives you an incentive for domestic corporations that earn foreign-derived intangible income in the U.S. So this is a U.S. entity exploiting its intellectual property globally through sales of product or licenses or services to earn revenue in the U.S. from foreign customers. So it generally provides a deduction related to that foreign-derived income of 37.5%, and this results in an effective tax rate of 13.125 for the what we refer to as the foreign-derived intangible income. So companies, in looking at this, will need to develop a process to be able to identify and track and support the foreign-derived deduction that's eligible for this income deduction. Again, the deduction for the foreign-derived intangible income, or FDII, and the GILTI is only available to C corporations. It's a fairly complex set of definitional rules, so you'd want to go through and sort of model out what this looks like in terms of the end result. Let's get to that example here quickly. We've got about 5 minutes left. We're looking at a very flat foreign organization. U.S. parent holds four foreign subsidiaries. We're assuming there's no interest or other limitations, and that all of the income earned by U.S. parent is either GILTI or FDII. So GILTI is the stick, meaning that the foreign-derived income of the foreign affiliates is taxed immediately in the U.S., and FDII is the carrot. The U.S. foreign-derived income has a deduction that's available. So let's look at the example, and maybe this will make a little bit more sense. A lot of numbers on the page here. If you look in the left top box, GILTI income, you first identify the tested income and your qualified business asset investment. The qualified business asset investment drives your routine return of 10%, which is your net deemed tangible income return, which is allowed. So any excess, which means your tested income over your deemed return, is the global intangible low taxed income. And you can see in that first box that we have about $3,130,000 coming through after we net out our routine return that's allowed. In the box below that, we're looking at our deemed paid foreign tax credit. The foreign tax credit in total is $150. We, under the FDII and the GILTI regime, under the GILTI regime, you're allowed to only benefit 80% of that foreign tax credit. And the available foreign tax credit is a pro rata share based on the inclusion percentage, which is 89.7. So when you multiply that out, 89.7 times 80% times 150, you get a deemed paid eligible foreign tax credit of 107.54. If we move to the right, the foreign derived income, we're going to remember that we get a deduction of 37.5% for the FDII and a deduction of 50% of the GILTI. We're going to assume for this example that our FDII income is $400. So the GILTI amount is taking our GILTI income plus the gross up of 100%, which would give us the 3,264, $3,264,000. And the total deduction then is going to be our GILTI amount with the inclusion plus at 50% plus the FDII income after the deduction added together. And then in the final box there for taxable income impacts, we look at our taxable income, which is going to be the GILTI inclusion plus the FDII benefit less those total deductions. You have your Section 78 gross up at 100% times your domestic rate, and you can see how the tax falls out after the credit of $287. We're coming up on just a couple of minutes, and I'm running out of time here. Lots to cover. I'm going to skip the polling question and just finish up with a few last planning points, if you will. The BEAT tax is an area that you need to be aware of. If you have $500 million in average annual gross receipts and you make certain base erosion payments, you will pay a minimum tax beginning at 5% on a portion of those payments. And there's been modifications to the Subpart F rules and the definition of intangibles. For planning considerations, we mentioned in the beginning that we needed to look at the presentation of the transition tax in our financial statements and the impact potentially of the FDII and GILTI in those financial statements. We might also need to look at pass-through detection, meaning looking at converting to a C corporation if you're currently a pass-through or an individual owning some of the foreign affiliates because of the detrimental lack of deductions, if you will. The final slide, and I think where most companies are starting to focus their attention, is looking at evaluating their supply chain and deciding, is it more advantageous to plan into or out of the GILTI regime, the Subpart F regime, or perhaps checking the box and bringing everything directly into the U.S. As I mentioned before, these are very math-based decisions, heavy in calculations, and they're very interrelated. So it takes a fair amount of modeling to determine which of these regimes are beneficial and which, under the operating guidelines for the organization, you might be able to plan into. And with that, I'm going to return back to Rihanna to close this up.
Well, thank you so much for going over all of that with us, and I do again apologize for the delay in audio that we experienced, which kind of gave us less time to work with. I did just want to take one question from the audience, and it was asked, how is selling apps around the world through the App Store and Google Play treated? The company based in the U.S. is paid in dollars in the U.S.
That's a very good question. As I mentioned earlier, the companies will need to develop processes. I've been told that as long as you have a foreign customer, you don't have to have foreign performance or foreign title transfers, our understanding, but a foreign customer, you're able to qualify the income for this FDII benefit. So you'd have to be able to trace through and somehow support that you've got a foreign customer for this app or any type of online sale for that matter.
Fantastic. Well, thank you all again today for joining us for today's webinar. I'm going to make sure that everyone gets a copy of the slide deck and a recording of the audio as well, sent out via email here shortly. And thank you to our two presenters. We appreciate your time and consideration for sharing this content with our community. Have a wonderful day.